Hello, and good afternoon, everyone. We'd like to welcome you on to today's event on business exit and succession planning, from ownership to opportunity. It's great to host everyone today. If anyone has got any technical issues throughout the event, please do feel free to contact us using the chat function. If you have got any questions throughout the event, feel free to put your question in the form, which I have just posted on the chat. Instead of putting your question in the Q&A box on Zoom, instead, if you put your question on the form that I just posted on the chat, we'll pick those questions up, and we'll be reviewing those questions after the event, and we'll get back to you on our thoughts on your questions afterwards. This is really just to allow as many of you who are watching this on the various different platforms that we're broadcasting this event on to ask us your questions. So instead of using the Q&A box, use the form which I've just posted on the chat to put any question you've got as you go through the event, and we'll pick those questions up and we'll come back to you on those after the event. So my name is Carl Taylor, and also on the panel this afternoon we've got Gerry Surtees, who is a chartered tax advisor here at Oldfield. Afternoon, Gerry.
Afternoon, Carl. Good afternoon, all.
Good. So today's event is all about business exit and succession planning, specifically for business owners that are looking to transition out of their current ventures to explore new priorities in the future. And we come across a lot of ambitious business owners, both clients and non-clients of ours, who've reached a certain level of success in their business, and they're really starting to look for an exit route. And it can be for a number of reasons. It could just be that you want to move on and do something different. Maybe the demands of the business are more than you want to invest, or maybe your passion is in something else. For example, you really want to get into property investment, and you want to build a property rental portfolio that will bring in a steady passive rental income stream going forward. Or you might want to start a completely different business altogether. So we're going to really be focusing on and talking about the key things you need to be thinking about over the next 3 to maybe 5 years to actually allow this to happen. So quick agenda on screen. Gerry's going to start by covering some key points around building a management team and incentivizing and retaining your key people. He's also going to talk about setting a target valuation, having a plan to get there. And I'll be covering some points around post-exit planning. And then we'll wrap up with some of the key takeaways and also frequently asked questions that we're getting asked on this subject. And we're going to cover some of those off. Hopefully that'll be helpful for you. And we'll also talk about the next steps from here. So I'm going to hand over to Gerry, who's going to kick us off with the first point on the agenda.
Thanks, Carl. It's probably an obvious thing to say, but the thing about an exit, a business exit, is it doesn't just happen overnight. You know, you're not just going to wake up one morning and say, I'm going to get out by tomorrow or next week. It's something that takes time and careful planning if it's going to be certainly successful or in some cases even possible. In practice, there's going to be a lot of things that depend on you as the founder and leader of your organization. If you're going to exit, the first thing you've got to do is have someone, or more often than not a team, who's able to take that on from you. This is important, certainly if you're passing on to a management team, but also even in an external sales situation as well. For the simple reason that you'll find it's easier to get a higher price and easier to walk away without ongoing involvement if you've laid that solid groundwork first before you start approaching external buyers. So the first thing is to identify who your successors are going to be, who's got the technical knowledge, who's got the customer facing skills, and who's got the leadership ability to be able to take this forward without you. And as I say, that might be one person, or more often than not, it might actually be a team of people who are going to take those roles on from you. Once you've got that, the next thing is, how are you going to provide the motivation to that team of new leaders and managers? What's in it for them? By this point, you might have some idea of what you want out of it, what you'd like to achieve from an exit. But at the same time, there's also got to be a reason for them to take it on and go on this journey with you as well. You want them to have enough in it for them to stick with you to help you realize those plans and goals. And this is really where a well-designed employee share scheme is really essential to help deliver on this. And there's lots of different ways that can be done, which we haven't got time to go into on this session today. But suffice to say that giving them some skin in the game is really important, so that they stand to win if the business hits its goals. And as I say, gives them enough of a reason to stay with you on that journey up to and potentially beyond an exit. So the design of an employee share scheme is really key to ensure not only that it's tax efficient and correctly implemented and all of those good things, but also importantly that it's very effective in providing the right targeted incentive for those employees, and also that it's well communicated to the employees as well. And it might sound a funny thing to say, but really a scheme is kind of pointless if it doesn't actually incentivize the employees to act in the way you want them to, maybe just because they don't really understand what it's all about. So the communication is really, really important. The next thing coming out of that is that in order to ensure that incentive is targeted, you need an overall plan for the business. What are your goals? Where are you heading? What's your target payout? And in fact, think beyond that. So what are your life goals? What are you wanting to achieve post-exit? And then what financially do you need in order to achieve that? Then work back from here and build a plan and targets for the business that achieve those targets and goals. And then lastly, you can then build an incentive scheme that ties in with those goals and brings those key people on the journey with you. The question of structuring an exit is the next point, and that is really all about who you're going to sell to, and what is the best way of structuring that so as to ultimately get the money into your hands as tax efficiently as possible. And there's, I guess, two main headings that we tend to talk about. The first is an external sale, which might be as simple as just selling your company in its entirety to a third-party buyer. However, what we often find is that companies or groups have acquired assets such as property, buy-to-lets, or other investments, share portfolios, and so on that you might want to retain. And ensuring this is separated in the right way well ahead of time so that you can effectively sell the bit that you want to sell and keep the bit that you want to keep needs careful structuring in order to get the right tax outcome. And ultimately, you might not want to be in a position, for example, where the sale proceeds from your company sale go into a company and you've therefore got to extract all of those profits out of the company and pay a lot of tax on that to achieve that. Much better if it can land in your hands directly, and that needs careful thought and forward planning. The second potential exit route is what we call a management buyout, which is a term many of you would have heard of, which essentially involves using your management team taking on the business and buying you out. So they'll do that, as the illustration on the screen here shows. They'll set up a special purpose vehicle, usually a company, to buy you out, and that can be either debt funded or leveraged in order to pay you out, or it can be paid out. You can be paid out in installments from future profits of the company. And as you would appreciate, here again, a really robust plan for the business is really important, so that both you and the future managers have the confidence that the business will generate the cash in order to pay you out and repay the debt. So that cash generation piece, the management team need the confidence to be able to see that there's a way they're going to be able to achieve that. There's a couple of different ways you can structure a management buyout, and with different tax outcomes. Could mean either paying tax at between 10 and 20%, or potentially no tax at all for you on an exit. Which route is best will obviously depend on your own particular circumstances, and the nature of who you want to take the business forward for you, and would obviously need specific advice on your situation. But in all cases, it's worth being aware of the fact that it's also possible for you to retain a minority shareholding. So if you wanted to keep a stake in the company's future success, or maybe you just want to reduce the amount of investment that your management team will have to make and the risk that they will have to take on, you can retain a minority stake in the business if that's something that you want to do. So there's a lot more detail that could be gone into than we have time for in today's brief session. But hopefully that gives you a bit of an overview, a bit of a taster of some of the things that can be done and achieved. And I'll hand you back to Carl now to talk about post-exit planning.
Thanks, Gerry. So really the key point with post-exit planning is it's really about thinking ahead. It's really the key thing. This is really all about what happens once you've actually exited, once you've sold your shares or sold some of your shares. This is all about what happens after that. But to get the best result with that, you do need to be thinking ahead. So ideally, you need to be thinking ahead about what you want to do with the proceeds of you selling your shares now, so that you can ensure your business and your interests are structured in the right way to achieve the best result when it does happen. You might already know what you want to do with the proceeds. If you don't, you need to give it some serious thought in view of minimizing the tax implications in the long run when the exit actually happens and you actually want to do whatever it is you want to do post-exit. So say you wanted to invest the proceeds of the sale of your shares in your current business in another business, for example, or in a property portfolio. The way you structure your business now needs to be completely different to the scenario if you wanted to use the proceeds personally for your own personal use post-exit. So, for example, if you wanted to invest the proceeds in another business, you would want to set your structure up now to allow for the proceeds of the sale to be retained in a company, in a holding company, potentially pay no tax on the proceeds of the sale, and then reinvest within a company structure so you don't ever have to extract the funds personally and pay tax on them personally to do that. On the other hand, if you want to use the proceeds personally, you'll want to structure it differently to allow the funds to get into your hands with the minimum tax liability. And there's a common question that we often get asked around post-exit planning is about inheritance tax issues and how to deal with those. So, if you've received a big cash payout, it's likely that you'll suddenly be much more exposed to inheritance tax than you were before when your wealth was tied up in business assets, i.e. your shares. So one route to deal with this is through a family investment company. That's one good example of a way to kind of deal with the inheritance tax problem that can arise in this kind of situation. It can be a good option. It allows you to keep proceeds within a company structure, so it's quite tax efficient and can also be used to minimize inheritance tax exposure as well. So the key with all of this really is about planning ahead as far as possible. And if you want to exit, start to make a list of things that you want to do with the proceeds of that exit. And we or your current tax advisor can sit down and look at that and work out the way you need to structure your business now to allow that to happen in the most tax efficient way in the post-exit scenario. So I think we wanted to just quickly run through some frequently asked questions now. Just these are common questions that are always cropping up when we're talking about exit planning with our clients. So it's just three key questions that often come up. So the first one here, if I'm planning to exit via a management buyout, how can I take the management team with me on the journey? We want to be transparent with them, but the more we grow, the bigger the payout they're going to have to fund. And I obviously want to maximize the value that I get ahead of my exit, but it isn't in their interest to do that. So there's kind of a bit of misalignment there. I don't know what you say on that one, Gerry.
Yeah, it's a good question. What we've done in the past in these situations is to build a plan for the business to show that by giving the employees equity now, this gives them a clear incentive to drive grow the value of the business, and importantly that will put them in a better, stronger position with more equity than if they hadn't come on the growth journey with you. Because of the result of the growth that's achieved by coming on that growth journey and helping you to hit those goals, they've actually ended up better themselves. So this is really all about creating a win-win situation that means that the management team are essentially aligned with your goals as the exiting shareholder.
It's good. Thanks, Gerry. Next, frequently asked question we've got here. I've invested in some buy-to-let properties in my company structure, and I want to keep these post-exit. What's the best way to do that? So the key point here is that you really need to separate out the properties from the company's trading activities well ahead of an exit, to allow you to retain one and divest the other. So there's different ways of doing this depending on what you're going to want to do with the sale proceeds at the end of it. But that's in essence what you need to look at. You need to look at separating the buy-to-let properties out from the trading entity, so that they're separate, and it allows you to kind of sell one without selling the other. Getting this right is crucial because it makes an enormous amount of difference to the tax outcome at the end of it. So third key question here, I want to exit, but no one wants to buy the business and the management team don't have the funds to buy me out. What do I do? Any comments on this one, Gerry?
Yeah, so I think a management buyout would be a good option to look at in that situation, which, as we've said earlier in the presentation, involves your management team establishing a special purpose vehicle, an SPV, to buy you out. The important point is that it can be either debt funded or leveraged, or it can be funded from future profits. So in actual fact, potentially the management team don't necessarily need to have or put any of their own funds in order to achieve that exit. The other potential route would be an employee ownership trust, which essentially is a way of transferring the ownership across to your employees, to all of your employees, via a trust. And it's kind of a way of exiting without exiting, if you like. The management team, again, don't need to come up with any funds in order to achieve that buyout. And if you want to, you can carry on running the company along with the board of trustees. So some options to think about on that one if anyone's in that situation.
That's great. So really, I think the key takeaways from today are these 4 key points, really. So firstly, identify successors for your management team. So think about who of your employees, who of your team has got the technical and the customer facing and the leadership skills needed to take the business forward without you, and provide them with the motivation. Look at some form of employee share plan to create a win-win scenario so they are aligned and motivated to maximize the value of the business. And think about your life goals, think about what you want to think about what you need to then arrive at a target valuation figure, so a goal for how much you want to be able to sell your shares for, and that then feeds in to your target valuation, and then feeds into your financial plan for next year, next 3 years, next 5 years maybe. And then think about what you want to do with the exit proceeds. Think about that now and make sure the business is structured in the best way now to achieve the optimum long-term tax result. So get good advice now to make sure your business is structured in the right way to achieve this. So if you have got any questions of your own on anything we've mentioned, feel free to post your questions on the form that was in the chat. If anything we've said has resonated and you've got challenges or questions around how to exit or wanting help with planning and structure an exit, then get in touch for a no obligation conversation. There'll be a link on the follow-up email coming straight after the event to schedule in a no obligation conversation with Gerry. There's also a link in the chat to do that now. So thanks everyone very much for joining us this afternoon. We look forward to speaking to you again soon. Thank you.